Hey guys, it's your boy VGOK here. I hope you're all doing amazing and are trading safely in the markets. Now welcome to the first video of the new series of the educational concept videos which I'm creating for you right now. In today's video, I'm going to be going over how important fractals are in the financial markets and how we can implement the idea of fractals in our analysis so that we can achieve these better risk to reward trades. I'm also going to be exploring how fractals are present within Wyckoff schematics, within the uptrends, downtrends, and within price action in general. Also, I'm going to be breaking down how I personally perform a top-down analysis and what I'm actually looking out for on each of the time frames, from the monthly down to the 1 minute. And I'll also go over why the reason top-down analysis works is because of the fractal nature of the markets. So without any further delay, let's get straight into the video. So before jumping into the actual context of trading, of how fractals are relevant, I'm just going to have a quick Google search of what fractals are. And as we can see, it says a fractal is a never-ending pattern. Fractals are infinitely complex patterns that are self-similar across different scales. This is definitely important when we talk about it later. They are created by repeating a simple process over and over again in an ongoing feedback loop, driven by recursion. Fractals are images of dynamic systems, the pictures of chaos. Now, just from this explanation alone, this amount that I've highlighted right here is definitely relevant to us in the context of trading in the Forex and indices and crypto markets, which I'll be going into in more detail in just a sec. Now, in the context of trading, fractals refers to the nature of the price action, specifically how price knows no time. In simpler terms, what this means is that price will not favor movement on one particular time frame. It will move irrespective of time and equally on the monthly as it will do on the 1 minute time frame. Now, trying to envision that and sort of see that in your head is going to be quite difficult, but one way that it's accurately represented within the charts, within the markets, is when we're looking at certain sort of chart patterns. And in regards to smart money and Wyckoff trading, the chart patterns, I'm going to say inverted commas, or the Wyckoff schematics, which we're more familiar with, we can see this when we analyze and label the actual schematics themselves. So what we can see from this screenshot that I've taken earlier in a section of my notes is we can see an accumulation schematic on the 30-minute time frame for Great British Pound against the Canadian dollar. And the 30-minute accumulation schematic is shown within the black box right here. And as you can see, we've got all the components of the accumulation schematic. We've got the preliminary support, the selling climax, the automatic rally secondary test, the secondary test in phase B, and then we have the spring followed by the break of structure. And as you can see, after the break of structure, we are valid for our potential buy entries on the 30-minute time frame. And this blue rectangle shows us our point of interest for taking these buy scenarios. And also what I've also highlighted in this red box here is the fractal accumulation schematic happening within the accumulation schematic. So what we have here is this, where it says test, this test is of the 30-minute accumulation schematic, and we have a whole new accumulation schematic acting as the test of that original schematic. However, if we actually zoom into the price action in the red box, we can actually see another accumulation schematic forming on the lower 5-minute time frame. So there's a whole new schematic occurring within the 5-minute time frame, and this test, as it says here, is the test of the larger scale, the larger time frame 30-minute schematic. So this is obviously showing us how we can have schematics within schematics and how fractals are present within the markets. Now, this is all well and good knowing that we can see fractals now within the markets, but what good is it for us? Like, how is that going to be benefiting us to make more profitable trades? Now, comparing the two positions that you can see on the video right now, what we can actually see is this buy position here and this buy position here. Now, this first buy position is the entry using the 30-minute schematic. We can see having our entry at the top of the POI right there, stop loss just below the spring right there, and targeting this structural high point right here. And that would be achieving a 1 to 7.5 risk to reward ratio. However, when we look at this buy position right here, this entry was using the 5-minute schematic, achieving a 1 to 13 risk to reward ratio. And you can see that there's a considerably higher risk to reward in the 5-minute schematic because our entry is in relatively the same spot, but in this instance here, we can see that the entry would be at that imbalance fill. We can see that the 5-minute entry would be as price fills in this imbalance here in this 5-minute testing area of the schematic, and keeping our stop loss below the spring of the 5-minute schematic right there. And again, keeping the take profit for this second entry at the same as the TPS for the first one, we can see we actually achieve a much higher risk to reward ratio. Both actually have the same TP point but have different risk to reward ratios. And the main reason for this is because we use the concept of fractals to actually get a smaller stop loss entry on the 5-minute time frame. This is how we can use this concept to effectively trade on smaller time frames and get smaller risk and higher reward trades. From this screenshot, we can actually see how that original definition that we saw of fractals relates to us in the financial markets. So as you can see, fractals are infinitely complex patterns that are self-similar across different scales. This is definitely showed to us when we can see schematics within schematics. And again, with this second part of the definition, they are created by repeating a simple process over and over again in an ongoing loop. So if you could even go deeper down, lower than the 5-minute, into the 1 minute and into the 1 second and further, you'd be able to see further schematics within the schematics in these scenarios. So we've just seen how we can see fractals with seeing the schematics within the schematics, and now we're actually going to be looking at how we can be able to see fractals within the market when we are looking at trends within trends. So what I'm going to draw out now is just a simple downtrend. So what we have here is a downtrend, and we can see that there are simple lower highs and lower lows. So what we have here is a downtrend, and just imagine that this is going to be on the 4-hour time frame for now. So on this 4-hour time frame, if we have a 4-hour downtrend, what you could also be seeing is in between, within each impulse and each retracement, you're going to be having mini trends within this major downtrend. So from this lower high to this lower low, what we'll be able to see is going to see the smaller trend within this first impulsive move. So you'll be able to see something that will look something like this. You'll have this micro downtrend within the impulse of here, and within this retracement, because it's a retracement of a major uptrend, you'll be seeing some sort of bullish uptrend like so, and it'll be continuing throughout each of the impulses and retracements that you'll see. And as you can imagine, it will be similar to this, like so. So just to reiterate, what we have, the red trend could be a 4-hour trend, and then the black trends, they could be equivalent to something, say, on the 15-minute. Now, when we relate this back to the original definition of fractals, it's creating that simple process over and over again. And the main one to do with the trends is this sentence right here. Fractals are infinitely complex patterns that are self-similar across different scales. Across different scales should be the thing that's jumping out at you, because what I've been talking about is across a different scale of time. So across a 4-hour and across 15-minute, we can still have the same downtrends and uptrends within a major downtrend. Understanding this whole concept of fractals, this nicely leads on to the fact of why we analyze in a top-down fashion, or a top-down style, if you will. Because when we're analyzing on the higher time frames, and then when we move down to the lower time frames, it can easily be, we can easily be confused by the movement. We could be perfectly, confident in our higher time frame analysis that we are in a big bearish downtrend. But if we were looking at just this part of the price action, say on the 15-minute, 5-minute, or whatever, on those lower time frames, and we see an uptrend, we're going to be basically counter trend trading. We're going to basically be trading, the bullish movement. We're going to be looking for buys within a higher time frame downtrend, which is why it's very important, and why a lot of the successful traders implement that top-down analysis within their trading. Now, before I actually go into how I do a top-down analysis, I'd just like to say it's not absolutely set in stone that these timeframes that you see, so the monthly, weekly, daily, 4-hour and 2-hour, it's not like these are definitely categorized as the higher timeframes, and it's not as if these ones here, so the hourly, the 45-minute, 30-minute, 15, 5, 3, and 1 minute, it's not as if these ones are definitely categorized as the lower time frames. They're literally just the way that I've divided them up from my own personal experience when I've been trading myself. Sometimes in the past I've also had my higher time frame point of interest be a 30-minute institutional candle, or a 30-minute point of interest, so which will give me the opportunity to go into the 1 minute and below to monitor the trade and really look for my entries on the lower time frames. Now, when I'm doing a top-down analysis, I'd always like to start on the monthly. More often than not, it's most likely going to be the weekly time frame. The monthly time frame, I feel like it's harder to see a lot of the points of interest and the imbalances and the structure. So more often than not, I am starting my analysis on the weekly time frame, and then obviously going down into the daily, 4-hour and 2-hour. But on the majority, most of these time frames, this is what we're establishing. This is what we're trying to find out from the higher time frame. So the first thing which I'll do is establish the major structure. The most important part of any analysis on within the forex or industry or whatever market you're trading is market structure in technical analysis. So you want to be establishing your major structure. So whether you are bullish, whether you're bearish, and in previous videos within my previous case study videos, you've definitely seen I've been marking out my structure points with those little blue or red circles, and that's how I mark out my bullish or bearish trends. The second part of what I like to do is establishing higher time frame points of interest, my higher time frame POIs. Now, these can be sort of derived from institutional candles, so areas of manipulation, supply and demand zones, so that could be whether you're seeing rally-based rally formations or drop-based drop formations, or even if it's just imbalances. Whatever it is, you want to be just establishing these larger general areas for you to refine your analysis later on in the lower time frames. And the main thing to understand about the higher time frames is, you want to gain the general directional bias from the higher time frames, and basically you want to grasp the larger areas that require the further analysis on the lower time frames. After you have established your POIs on the higher time frames, you would be moving down to these lower time frames to monitor price once price is in the POIs. So, I'd say most of my time analyzing goes into the lower time frames, but that doesn't mean the lower time frames are more important than the higher time frames. If anything, the higher time frame analysis is much, much more important than the lower time frame analysis. The higher time frame bias, in my opinion, and I'd say a lot of other traders' opinions, is the analysis you want to be getting right, the analysis you want to be consistent with, and the analysis that you want to really be perfecting. So moving on to this lower time frame analysis, like I said before, once we have the higher time frame points of interest, this is the instant where you're setting alerts around your higher time frame points of interest. And what we want to be doing is we want to monitor the price action from the previous POIs. You're going to be waiting. Obviously, your higher time frame points of interest are going to look a lot larger. Your zones are going to look a lot larger once you're jumping down into the lower time frames. So it's very important that once you're on these lower time frames, monitoring the price action, this is where you want to be the most patient in your analysis. Now, essentially, in these higher time frame point of interest, when you're in the lower time frames, you want to be watching price as it is in the point of interest. So essentially what you're looking for in those areas are these lower time frame breaks of structure, so the lower time frame BOSs. You want to be looking for these Wyckoff accumulation and distribution schematics, which if you've seen my previous case study videos, I've gone over a lot in detail. And again, instances manipulation, so where you see a set of highs or a set of lows that get manipulated out, where you see that buy to sell movement on the highs, or you see the sell to buy movement on the lows that are being manipulated. Also, something important to consider when you are analyzing on the lower time frames is to factor in any other variables, such as the time of day so that you're trading. So, the session which you're trading. So say if you're trading something like GBP USD, you want to ideally be trading within the London or New York session. If you see price coming into your point of interest, if you see price coming into your higher time frame point of interest, in Asian session, chances are that your directional bias, your trade is not going to pan out because GBP USD doesn't naturally move a lot. It may do sometimes, but naturally it won't move a lot during that Asian session. Also, you want to be taking note of any big news events that may shift the market in a big volatile manner. So, news events such as NFP, which is always the first Friday of each month, or whether it's FOMC or whether it's unemployment rates or other interest rate releases. These are the main news events that will naturally move the market and shift the market. Also, another few points that I want to just to remember. I see a lot of traders out there that are totally transfixed by seeing and trying to analyze using Wyckoff analysis on every single time frame. So they're trying to find this huge monthly or daily or weekly Wyckoff distribution or Wyckoff accumulation schematic. The main thing to understand is that Wyckoff logic is one small aspect that ties into smart money trading or institutional trading. More often than not, when I'm using Wyckoff myself, it's typically only on the 30-minute and below timeframes. I'm not trying to label and analyze a huge schematic on the weekly and daily. Understand that Wyckoff. I'll go into more detail about Wyckoff and the whole detail of Wyckoff analysis in a future video. But I usually use Wyckoff analysis on the lower timeframes within the higher timeframe points of interest. And also another point which I just want to go over is I don't naturally just stick to these given timeframes. So these ones on the top of you that you see on top of my trading view, I've got the 1, the 3, 5, 15, 30, 45 minute, and then it goes to the hourly, 2 hourly, 4 hour, and then daily, weekly, monthly. They're not the timeframes that I just stick to. Like we discussed earlier when talking about how the markets are fractal, price knows no time. It can move in the same manner on all timeframes. So why should we limit our analysis to just these timeframes? Why should we only look at the charts and analyze on just these timeframes? In the past, I've looked at these in between sort of time frames. So stuff on the higher time frame aspect, stuff like the 6 hour, the 8 hour, the 12 hour. Also on the lower time frames, I've looked at these other in between sort of time frames. So stuff like the the 2 minute, the 4 minute, the 6 minute, all these other little in between sort of minute based time frames, whether it be 10 minute or 90-minute time frame, whatever it is. Essentially, what we're trying to be looking for is what time frame can I see the best looking manipulation. So what time frame can I see the best looking institutional candle? Is it clearer on a 4 minute institutional candle where I can base my entry off, or is the higher time frame point of interest on the 8 hour or the 6 hour a lot better than the 4 hour or the 2 hour? So whether you basically want to be seeing where the best looking manipulation, the best looking institutional candle is, or where the best looking supply and demand zone is. So in terms of looking at rally based rally and drop based drops, where's the cleanest instance that you see the rally based rally taking out previous supply, or where's the cleanest instance, on which time frame do you see the cleanest drop based drop taking out previous demand? Essentially on every single time frame, what I've found myself looking for is we're looking for manipulations. On higher time frame manipulations, they will give us our points of interest, and on lower time frame manipulations, they will give us our entries. Also, another point to remember is you always want to be favoring your higher time frame directional bias over your lower time frame analysis. More often than not, when going down into the lower time frames, and when you kind of forget, and it's happened to me in the past as well, it's definitely happened to me in my trading career as well, I've sometimes just gone away from the higher time frame analysis and just been solely concentrating too much on these lower time frame analyses. So understand that the higher time frame analysis will give you your main directional bias, and then when you're going into the lower time frame analysis, you want to be keeping that higher time frame directional bias, so whether you're going bullish or bearish, in the back of your mind, and you want to be going with that trend. So if the higher time frame is saying bullish, then you want to be looking for buy scenarios on the lower time frames, and if the higher time frame is saying bearish, then on the lower time frames you want to be looking for those nice sell scenarios. Now in this instance, I'm not actually going to be going through a chart example of how I do a top-down analysis, because in pretty much of all of my previous videos, as you can see, the previous videos which I've posted on my YouTube channel, all the previous case study videos, in all 7 of these, and by the time that this video is going to be posted, there will be an 8th case study video as well. In pretty much all of the videos, I've analyzed using a top-down analysis. So if you'd like to see chart examples and actual market examples, please do go back to these videos and rewatch and take notes of them. With that being said, that brings us to the end of this video. I hope you guys will take value and learn from this video, and if you did, please do like, share and subscribe. Thank you for watching, and I'll see you guys in the next video for more of that trading sauce.